Hi, good evening, ladies and gentlemen. I'm Simon Teo from Phillip Futures. Thank you for joining me today here for this session, where I'll be sharing with you some technical analysis trading strategy that we can use to trade the US indices. So before I start, maybe just a brief introduction about myself. Okay, I was a futures dealer as well as an FX dealer before. So I've been with Phillip for more than 10 years. And during my time in Phillip Futures, right, we me and my colleagues actually did a lot of technical analysis and models and training. So today here with me, right, I will share with you one of the models that we have been using to analyze the market as well as to identify the trend to trade the US indices. Okay. So before I start, just a simple disclaimer, right? So whatever discussed today is for education purpose. There's no trading call, or it doesn't represent any of the companies or my own personal trading calls, right? So just a simple disclaimer. And this will be the content for today. So for the next hour or so, I'll be sharing with you this few things. So first of all, we'll be discussing, going into a brief introduction to technical analysis. So what exactly is technical analysis, and why do people use it? Okay, and followed by, we'll be given an introduction to moving averages and relative strength index. These will be the two indicators that we're using today to identify the trend as well as to set up for entry. And part two of the seminar will be talking about how we use these two indicators to come up with a strategy, with a trading strategy. And then I'll share with you a simple three-step entry to a trade. All right, so this is what we'll be discussing today. So in the session today, I will not be going into the brief details about what is CFDs, what are CFDs contract, or what is leverage trading. It'll be more on a focus on technical analysis. So if let's say you have any questions regarding what is a CFD or the basics of leverage trading, do feel free to keep my contact later on, and you can contact me. We can have a separate session after this. Okay, so just a warm up before I go into the seminar proper. Most of the time when we talk about trading, we'll hear people talking about is it EQ more important or is it IQ more important? All right. So to be successful in trading, a lot of times people say that, oh, we need IQ or EQ. But what exactly does IQ and EQ have to do with trading? How do we implement IQ and EQ in our trading? Okay, so for a warm up to get us started, to keep your attention, so just maybe to ask this question so that we can think about it during the session. I will share with you more details on this at the end of the session. So stay with me till the end of the session, and we'll have a short discussion on this topic. All right. So I'll begin the seminar proper. So first part is the introduction. So what is technical analysis? We always hear people talk about technical analysis, about TA. What exactly is it about? To me, technical analysis, right, is actually a pattern recognition technique, right, that uses a historical price action movement to find repeated patterns. So the keywords are highlighted there. You can see that pattern recognition and repeated patterns. All right. So in technical analysis, what we are trying to do is we want to find repeated price action, some patterns that we can use to try to forecast the prices moving forward. So for example, if you have been into trading for a while, you probably have heard of things like terms like double top or double bottom. Okay, this kind of trading patterns. So why do people say that, oh, double top, right? Most likely prices are coming down. or double bottom, maybe it's going to reverse and rebound. It's through history, people see that these patterns have been repeating, and when they see the similar pattern forming, right, they'll use this as a trading opportunity. So like history is going to repeat itself, and then we use this as an opportunity to trade. So technical analysis is really about pattern recognition and trying to find in the very so-called chaotic market, right? We try to find a pattern that's repeating and use that to forecast price action. Okay. So there are different types of trading strategy. Okay, what do I mean by that? There are many different ways to trade the market. So there are some people, or I would say most of the professional traders, right? They'll be doing scalping, or what we call very short-term trading. Okay, it's a micro-term trading, we call it. What does this mean? It means that you probably need to be at the screen, watching the market, and you probably buy and sell and take profit within a few points or few ticks. Okay, so professional traders like this strategy because first of all, you're not in the market for a long time. You can see result fast, and also your risk probably will be lower because you're in and out of the market in a very short time. You don't hold overnight or long-term position. So one of the trading style that traders use, right, is called scalping. So another type of trading style is what we call an intraday position trade. Intraday position trade aims to close the position by the end of the day, but usually we don't buy or sell so fast within minutes or seconds, right? But we try to position and get the swing, the whole movement for the day, and but by the end of the day, probably we'll try to close out the position also. There will be no overnight position. Okay, and a third kind of trading strategy is what we call the intraday swing trading. Most of the time, you will require to hold position overnight if you're doing a swing trading. You probably will hold 3 to 4 days or even weeks, depends on the trend, right? And this kind of trading style, right, we are trying to catch the turning point of the price, turning point of the price action. So usually the trend when it changes, this is where the intraday swing trader, intraday swing trader will come in to buy or sell. Of course, these are the three more popular way of trading. It doesn't mean that these are the only ways to trade the market. Okay, but when we talk about trading, right, usually we classify them into these three different type of styles. Why is it important to classify your trading style? Because different people, different traders will have different personalities, may have different way or different time that we can commit to our trading. So to find the trading style that suits us is very important, because if we don't have a style that suits us, right, or our lifestyle, we may not be able to execute the trade properly or monitor the trade properly. So right here today, I'll be sharing with you more on the second type of strategy, the intraday trade position. Okay, this strategy is usually more popular with for people who are not really full-time traders. Probably you have a full-time job and you still look to want to trade the market, and you are able to check prices every now and then within the day. So this strategy will probably be suitable for you. Okay. So next part I'll be talking about the indicators that we're using today. So first up is the moving average. If you have been trading for a while and you have been using charting, right, I'm sure you've heard of this moving average before. So the moving average type that we'll be using today is the exponential moving average. There are a lot of words here, but we don't really need to understand the formula behind it. Okay, more importantly is we need to know where to find this indicator in the chart and bring it out to use. So what's the difference between a moving average and an exponential moving average? The simple difference is exponential moving average, right? when they're calculating the moving average line, it places a greater weightage on the more recent closing prices. Okay, why is this important? Because we are trading short term, we are not holding position for a long time, so we want the moving average to react faster to the recent prices. Okay, so that we can have a view, or we can have a gauge of the trend more up to date, right? So moving average, just a simple moving average, usually for people who are in long-term investment, they want to see a longer horizon, and simple moving average will be useful. But for trading or for short-term trades, right, exponential moving average may work better because of the reaction that to recent prices. Okay, so this is the first indicator that we're using today. So how does it look like on the chart? You can see that there are two lines here, the blue and orange line. So these are moving averages line. We can preset them. Okay, later I will show you what are the settings for these moving averages. So we can set them to have a different period, to measure different period. Right, so this is how a moving average looks like. The next indicator that I'll be using today is the relative strength index, RSI for short. So you can see that it's usually below the price, below the chart, the main chart. So this relative strength index actually tells us how fast prices are moving. Okay, it has two levels. Okay, sorry, this is the description for RSI. So it's actually a momentum oscillator that measures the speed and change of price movements. See how fast prices are changing. It oscillates between 0 to 100, but normally we will look at the 30% and 70% level. Okay, so this is how when you zoom in, this is how it looks like. So you can see that there's a 30 and 70 level. As according to the creator of this indicator, right? If the RSI goes below 30, it's a short-term signal that prices are temporarily oversold. Okay, that means prices are falling too fast, and it's probably oversold. And if it's above 70, above 70%, prices is moving up too fast, and probably it's in the overbought region. Okay, so this is a indicator. This is how the creator defines how we use this RSI. All right, so just keep in mind these two indicators. Then we will see how we can use these two indicators to actually come up with a strategy to trade. Okay, so to the strategy, part 2 will be talking about the strategy. So the first step for any trading strategy, right? Usually we want to know what is the trend. Okay, the first step is always to look at the trend. How do I identify, is this going up or is this going down? So we'll be using 5 moving averages to determine the intraday trend. Okay, so the settings are as follows. Okay, these will be the 5 moving averages. So in total, you will see 5 different moving average lines on the chart. Okay, the period will be 5, 20, 50, 100, and 200. So what does this 5, 20, 50, 100, 200 means? If 5 means that it will use 5 candles. Okay, 5 candles, 5 price candle. If we can go back, so you can see each of this bar here is 1 candle. So 5 means that the last point of these moving average lines will be using the previous 5 candles to calculate the average. Okay, so sorry, apologize. Yeah, so when we say 5, right, means it's using 5 candles to calculate the average price. 20 candles, and so on. All right, applied to close. The trading time frame we'll be talking about, looking at, will be 15 minutes or 30 minutes. When do we choose the different time frame? By default, usually I'll go with 15 minutes first. Okay, but if the market is out of range, or I would say it's extremely volatile, or it's not the normal trading range, right? It's out of the normal trading range, I will switch to a higher time frame, probably a 30 minutes time frame, so that you can cancel more noises, right? So by default, usually we start with 15 minutes. And if let's say you find that the market is a bit more wild or more volatile, you can switch to a higher time frame. Okay, all right. So how do we define what is an uptrend? Okay, in this case, you can see that the 5, the pink color one, this is a 5, this is a 20. The second line is 20. The blue, the light blue will be 50, and the dark blue is 100. The orange line will be 200. So if the smaller line, the smaller number is above in sequence 5, 20, 50, 100, 200, this indicates the start of an uptrend. Okay, this can give us an indication that this is a beginning of an uptrend. Okay, so we can see that the lines maybe before that was a bit mixed up, but then when it starts to form a sequence 5, 20, 50, 100, 200, this will be the start of an uptrend. Okay, so once we identify the starting point of the uptrend, in between the moving average line may still cross over each other, but as long as prices remains above the 200 EMA line, which is the orange line, the uptrend is still valid. Okay, so let me just repeat this. Once we identify the starting point of the uptrend, when we see the sequence 5 above 20, 20 above 50, and 50 above 100, 100 above 200, when we see this sequence in the moving average line, this tells us that this is probably a start of an uptrend. Okay, so from there onwards, as long as prices, the candles remains above EMA 200, which is the orange line, the uptrend is still intact. So regardless whether the moving average on top, the smaller moving average on top, they are starting to crisscross each other, right? It doesn't matter as long as prices remains above EMA 200. Okay, all right. Now for downtrend will be a mirror image. Okay, if the smaller moving average will be below, the sequence will be 5 below 20, 5 below 20, 20 below 50, 50 below 100, and then 100 will be below 200. Okay, so when we see this, right, this will tell us that this probably is the start of a downtrend. There is an indication that this probably is the start of a downtrend. So, and the same thing, as long as prices stays below the EMA 200, the orange line, the downtrend is still valid. Okay, the downtrend is still valid. So in this case, you can see after we identify the start of a downtrend, in between the lines may cross, the smaller lines may still cross, but as long as prices remains below the EMA 200, it is still a downtrend. Okay, I hope everybody is still following me. So right now, you may have a question to ask like, oh, but it's pretty obvious this is a downtrend, isn't it? Because the prices, you can see that it's a lower low, lower highs. So it's obviously a downtrend. I don't need the moving average to tell me that it's downtrend. So same for this uptrend is pretty obvious. Okay, higher highs and higher lows. So it's a very obvious uptrend. Yeah, but market is not always so obvious. So for example, if we look at the chart like this is the Nasdaq 100 chart. Okay, Nasdaq 100 chart. If we are given a chart like this, sometimes it's very difficult to identify is this going up or going down without any indication. So now, if let's say I add in the moving average lines, okay, so I add in the lines, you can see that at a glance, we can say that generally it's more bearish. Why? Because the prices are below the EMA 200. And you can see at the starting point, there's the sequence 5, 20, 50, 100, 200. Okay, starting from the left, you can see that there's a sequence. So probably this is the start of a downtrend. Okay, another example. So with this screen here, you can see that prices seems to be ranging. But is it ranging? once we add in the moving average line, it tells us actually that this is actually a more bullish trend. Why? Because on the left, starting from the left, you can see 5 above 20, 20 above 50, and so on, 100, 200, and prices remains above the EMA 200 line. So when we see this at a glance, it's an indication that the market is more bullish today, right? So same thing, this is the Nasdaq 100 chart, right? The market is more bullish today in this case. Okay, probably this is the last example. So same thing, when we see something like this, we are not sure what's the trend. So we add in the lines. Okay, this is a bit different from what we have seen previously. If you can see that the lines are really not in sequence, okay, they are crisscrossing each other and prices are cutting up and down above the EMA 200. So this simply means that the market is in range trading. Okay, so if you see a pattern like this, it's an indication that the market is in range trading. So for this strategy that I'm sharing today, if it's a range trading market, right, we will not be able to implement the strategy. Okay, the strategy that we are sharing today, right, is more of a trend trading strategy. So we need the market to be trending, whether it's an uptrend or downtrend. Okay, so if you see, but of course we can still use this as an indication that it's a range trading. So if let's say you have other ways to trade the range market, probably you can implement that strategy and use it if you see that the moving average is not showing any a trend at the moment. Okay, so it's very important, like I say, to identify the trend at the start so that we know what we are supposed to do. Of course, on an uptrend, we will be looking to buy on dips. On the downtrend, we'll be looking to sell. We'll be following the trend. So it's not a counter trend strategy, it's a trend following strategy. So uptrend buy, downtrend sell. Range trading, we will stay out of the market, and probably you can choose another contract, maybe the S&P or the Dow Jones to see whether there's any other trends. Okay. Okay, so we have learned how to identify the trend. So where do we enter? Okay, take a look at this example here. We can see that on the left side of the chart, okay, in the beginning is actually a range market. You can see that the lines are crisscrossing each other and the prices are also cutting up and down the EMA 200 line. But then it starts to form a trend. Okay, you can see that the 5 starts to be above the 20, 20 above the 50, 50 above 100, and 100 above 200. And then you see that this is the beginning of the trend. And from here onwards, we will define that we will identify that this is the uptrend. Okay, this is a potential uptrend. All right. So on the uptrend, we are looking to buy. And where do we buy? Based on our observation and the patterns that have been repeating, right? The higher probability trade to buy will be when prices hit either the 100 line, which is the blue line, or the 200 line, which is the orange line. So even though it's an uptrend, we don't jump in and buy immediately. We wait for price to come down to have a correction, okay? And when it's near the support level, which is the blue or the orange line, the 100 or 200 line, then we enter our trade, okay, to buy. So you can see here the example, okay, a few trading opportunities, right? So you hit the orange line, you can buy, and then it goes up, come back down the orange line again, you can buy again, up, and then here it goes to the blue line and up, and then finally hits the blue line again. Okay, so if it's a range, if it's a trending market, right, this strategy will be very useful. And most of the time you will see that the 100 and 200 line will provide very good support in the trend market. All right, so this is the first example. Now this is a downtrend, right? So same thing from the left, on the left side, we see that before that was probably a range market also, and then it starts to break down. break the support, and then you can see that the moving averages are starting to form a sequence. Okay, the smaller below the other, right? And this is where we identify the start of a downtrend. So same thing, on a downtrend, we'll be looking to sell. Okay, looking to short. So we will wait for prices to rebound or recover back to the 100 or 200 line before we enter a short trade. So you can see here there are a few opportunities to short. Okay, so when the prices come back to the 100 line, we can sell, and then it comes down, and then when it rebounds back to the 200 line again, we can sell again, and then it comes down. Okay, so this is the second example on a downtrend. And okay, before I show you this the next slide, right? Probably you have some question in your mind, like okay, yes, I know that 100 and 200 probably in this case is a resistance, but between 100 and 200, actually the price difference can be quite a lot. So if let's say I try to short at the 100 line, but instead it rebounds further into the 200 line, I may start to panic because it may be about 100 points difference between the gap between the 100 and 200 line. So is there a better way to tell us which support or resistance should I use at that point? Should I use the 100 line? Is it time to use the 100 line, or should I wait for the 200 line before I short or buy? Okay, so like I mentioned earlier on in the at the start of the seminar, we have two indicators. So we have used the moving average to define the trend, as well as use it for entry, for support and resistance. We have one more indicator, which is the relative strength index. Okay, so this indicator will allow us to decide whether should I use the 100 line to enter, or should I wait for the 200 line. So how does it work? Let's take a look back at this example. Okay, now we add in the RSI. So you can see the RSI below the chart. And just to recap, for the RSI, below 30%, right? It's a indication of a temporary oversold. Means prices are coming down too fast and maybe oversold. Above 70 is an indication that probably prices are overbought. Okay, prices are overbought and going up too fast and is overvalued, right? So adding in the RSI and this on an uptrend, in this case, when the price hits, if you take a look at the first pair of circle, when the price hit the 100 line, the blue line on top, you can, if you look down, RSI is still above 30. There is no indication of an oversold yet, right? Oversold, or we can say in another term, is undervalue. Of course, when we want to buy things that are undervalued. Okay, so when we are buying, right, we want RSI to be oversold, okay, to be below 30. So in this case, when the price on top hits the 100 line, right, if you zoom down, if you look below, RSI is still above 30. Only when the price hits the EMA 200 line in the first circle, if you look down at RSI, it's actually going down below 30, near to 30. Okay, and this is probably an indication that okay, it's probably oversold. Prices are oversold now, and it has hit the support, so I could look to buy. Okay, so if you take a look at the second circle, same thing. Prices came down and hit the EMA 200 line, the orange line, and you look below, RSI is below 30. So this is also a trading opportunity. Okay, it's an opportunity for us to buy because it has hit the support and prices are oversold or undervalued. Okay, so it's time to buy. Same thing, the third circle, if we look at it, this time round, prices didn't hit the EMA 200. Okay, it started to rebound after hitting the EMA 100 level. So if you look below the RSI, it's near to 30. Okay. Of course, the RSI at that moment, right, when it's coming down, is probably below 30. But because this is a historical chart, when prices move back up, right, the RSI also follows suit and went back up. So, but at that moment, when it hits this 100 EMA, right, I'm sure this RSI was below 30 at that time, okay, or at least close to 30. So, these are some of the indicators that we can use to trade. So, let's see whether we have another example. Yeah. So you can see that there's this is on a downtrend, okay, on a downtrend, and obviously we can, from even without the circles, I'm sure you can identify a few points that you can enter. Okay, sorry. Yeah. So you can see that there's opportunity here. The first when it hits the EMA 200 line, okay, when prices rebounded to the EMA 200 line, and if you look down below the RSI, it's also close to 70. So when it's on a downtrend, we want to short when prices are overvalued. So above 70 is probably an indication that prices are temporarily overvalued. And if it also hits the resistance, it's probably a good opportunity. Okay, the probability of it coming down after hitting the resistance will be higher. All right. So this is a downtrend. Okay, and all right. So just a quick summary of the trade setup. Okay, first, we need to use the moving average to define the trend to trade. So if it's on uptrend, then we will look to buy. If it's on the downtrend, then we will look to sell. So based on the 5 moving average, we can identify what is the likely probability of the trend for that day. And once we identify the trend, we don't straight away jump in unless it's near the major support or resistance level. Okay, so the major support or resistance level will be at 100 EMA or 200 EMA. So once we identify a trend, we'll wait for retracement back to EMA 100 or 200. And the last step is we'll look after it hits the 100 and 200, right, or 200. We'll look at RSI for overbought or oversold signal. So if you are buying, we want RSI to be below 30, which is oversold. And if you are shorting, we want RSI to be above 70, which is an overbought signal. So if prices hits the major support levels, 100 and 200, as well as RSI showing the overbought or oversold signal, it's a higher probability trade that we can try to take. Okay, of course we must be with the trend. All right. So this is a simple summary of the trade setup, trade strategy that we have. Okay, due to time constraint, I won't be able to share in much detail how do we do the take profit as well as stop loss. But I will just quickly share with you the indicator that I use. Most of the time, I will use an indicator called the average true range. Okay, ATR for short, average true range. The purpose of this average true range, right, is to identify the trading range for a period of time. So you could use a 1 week period or 2 weeks period depending on your trading time frame, trading horizon. So for me, usually I use a 1 week horizon to identify the trading range. So once we know the trading range, then you can set your stop loss and take profit accordingly. For example, if let's say I'm trading in Nasdaq and it has been trading on an average of 200 points per day. So definitely when I enter a trade, I won't be targeting 300 points or 400 points because the range is not there. At least from the historical point of view, for that week, the range is not there yet. So of course, unless there are news or releases or anything that changes the fundamental, then you may want to tweak on the take profit. But normally, if let's say the range has been about 200 points, you may want to set about 150 as your target profit to take. And stop loss usually is 1:2 ratio. So if let's say your take profit is 150, then stop loss you may want to put at 75, things like that. Okay, yeah. So of course, if you have any more questions, right, then after the session I will leave my contact. You can just contact me or email me to ask anything on this session. Okay, so right now, let me see, sorry. Okay, so right now let me just quickly go to the live MT5 platform. Okay, live MT5 platform, and we take a look at the live chart. Okay, so just give me a minute to set this up. Okay, MT5. Okay. Yep. I hope you are able to see my MT5 screen. Okay. So this is the Nasdaq 100 chart, right? And it's on a 15 minutes time frame. So based on this chart today, we can see that previously, for the past 2 days, right? We see that it's more on a downtrend. Okay, more on a downtrend, and just probably this week, okay, it starts to break above the EMA 200. It starts to break above the EMA 200 on 21st September, okay, and after that it stays above the EMA 200. This is the first sign or first indication that the downtrend is changing. Okay, it probably is going to be in a change to a range market or a reverse back to uptrend. So in this case, it's more likely that it's turning up. Okay, because we see that it's starting to form the sequence 5, 20, 5, 20, 50, 100, 200, as you can see. So this could be a start of a reversal, start of an uptrend. Okay, so previously there was a downtrend, a big drop for a few days, and then after that it breaks above and stay above the EMA 200. Okay, once we see this pattern, if we are short, right, if I have a short position, we don't need to wait for it to hit our stop loss before we take ourselves out. Once you see that the prices has reversed and stay above EMA 200, you can try to cut loss already, okay? Because it's probably the first earliest indication that the trend is going to reverse. All right. So for today, we can see that it's more likely to be on the upside. Okay, although it may not seem too strong because the gaps between the moving average are still not very wide. Okay, it's just beginning to open up. So what I'll do if I'm trading this index today, right, is I'll wait for price to drop to 100 or 200 and check the RSI. If it's below 30, I'll take a long. I'll do a buy. I'll do a buy order. Okay, so I'll do a buy order if it's for today. So that's how I do the analysis and how to do the intraday trading. Okay, we can also take a look at other tools or other contracts. So this is in Nasdaq. Okay, the US index, usually they are quite similar. Okay, they have very strong correlations. So you can see this is the S&P 500, very similar pattern. Okay, drop for a few days, probably about a week, and then starts to reverse upwards. And now it's more on the bullish side, just turning to be bullish. Whether is this a sustainable trend, we still don't know. It could be just it could just become range trading. But based on the rules, right, and the formula, the strategy, if the price comes down to EMA 100 or 200 and the RSI is below 30, we can take a long. We can try to take a long position, a buy position. Okay, but if let's say price comes down to EMA 200 and the RSI is still above 30, then you may want to wait, because it's possible that it becomes a range market from here onwards. Okay, so only if let's say there's an oversold signal, then we try to take a trade. And of course, if the price must be above EMA 200 and there's oversold, then we try to take a trade. Otherwise, we may want to be more patient about it and then just wait it out and see whether is it going to continue to go up, or is it going to be a range market. Okay, so this is for S&P 500. Dow Jones, I'm sure is pretty similar. Yeah, you can see. Okay, Dow Jones chart. This is a live chart. It's pretty similar. So same thing. We'll wait for prices to come down and the RSI to be below 30. But although at first glance, if you see, right, the trend may look similar, the pattern may look similar, but from what I see, right, I think the Nasdaq 100 is actually stronger. Reason being, you can see that it has reversed earlier. Okay, on the 21st, it has already started to break above the resistance, and the pattern is clearer. All right. And as well as the RSI, you can see it's actually closer to 30. So there's a high chance that when it comes down to 30, right, this RSI is already oversold, right? Compare this to the S&P. I would say this is the medium bullish. If you compare to Nasdaq, Nasdaq is the bullish. Okay, among these three, this one will be the second. Okay, same reason. You can see that the pattern is formed, but the RSI, you can see that it's higher compared to the Nasdaq. Okay, let's just switch back. You can see. Okay, this is at 48, whereas the S&P is at 55. Right. The Dow Jones is worse. Not worse. I mean, this is the not so clear trend yet. Okay, because you can see that the last moving average has not really broken through, and then the RSI is quite high. Okay, it's still quite high, so it's not anywhere near the oversold region. Okay, so if I were to do among these three tools, right, or three contracts, if I were to trade, I'll probably choose the Nasdaq for today. Okay, so hope this makes sense to you. All right. Okay. I'd say more or less this is the session or the sharing. It just allowed me to share a few more things with you. Okay, let me just switch my screen back. Sorry, I'll do this. Okay, let me just switch my screen back to the slide. Okay. So we went through the live chart analysis. Okay, so seems like Nasdaq may be a good opportunity today. But let me just share with you more about the MT5. Okay, the MT5 is our latest platform that allows you to trade FX, gold, CFD. CFD will include shares, individual counters, stock indices like the US index, as well as some Asia indices, and oil. Okay, recently we just added on cryptocurrencies in the list of asset classes inside MT5. And what is so good about this MT5 is any asset class that you find here, any contract that you find here, everything you trade here is zero commission. This is one of the strongest selling point that we have. So even shares or stock indices or oil, gold, everything is zero commission. Okay, and for those of you who have been trading FX, Forex, you probably have heard of MetaTrader 4. MetaTrader 4 is an award-winning platform, and this MetaTrader 5 is the newer version of it. Okay, so and the advantage of this platform is you can actually go down to micro lots. Okay, micro lots. So if let's say you're very new to CFD trading, and you want to start slow, yes, you can try out micro lots so that your risk is lower to begin with. And for our clients who open account and uses MT5, right, we have free tools for clients to use, like the Auto Chartist and the Trading Central. Okay, so Auto Chartist is something like a scanner. It's a tool like a scanner, so it will look through the whole list of product that you have on your watch list, and it will identify using some program pattern inside the algo, and identify what are some of the products that have trading opportunity. So for example, if let's say gold has some movement and it's in line with the algo, it will pop up and show you that, oh, gold has some trading opportunity. Okay, so you can check, it's something like a scanner. So if you have a lot of things in your watch list, a lot of contracts on your watch list, this may be useful for you. And Trading Central is more specific to the product that you want to watch, that you want to trade. So for example, if you are mainly trading the Nasdaq 100 and you want a view on Nasdaq 100, so you can use Trading Central and input the program into MT5 and pull out the Nasdaq chart. It will give you the view, the Trading Central's their view on what's the Nasdaq trend going to be like. Okay, so these are free tools that our client will enjoy when trading with us. Okay, so if you like to try out the demo, just feel free to scan the QR code here. Okay, and then you can download a demo for free. There's no expiry, so you can try until you're comfortable and you're ready to open an account with us. Okay. Okay. So if let's say you're ready to open an account, okay, you can open it online. So you can scan the QR code on the screen, and you can proceed to open an account online. So all you need is a soft copy of a bank statement. And if let's say you're Singaporean and you have a SingPass, you can log in using My Info. That will save you a lot of time to key in your personal particulars, and yeah, then you probably take you 5 to 10 minutes to open an account to fill up the form. Okay. And okay, this is the upcoming promotion. So if let's say you are our clients, or if you are not yet our clients, this is a good reason probably you can consider to open an account with us as soon as possible, because this promotion will be starting from 1st October. So what is this about? This is the more you trade, the more chances you get for the lucky draw to win the prizes here. Okay, so the top prize will be an Apple MacBook. Okay, there's also iPhone and trading credits. Okay, to win. So the more you trade, the more chances you'll get. All right, so this is the upcoming promotion. So let's say you're interested and in trading CFDs already, maybe you can just take this chance to open an account, and probably you can also enjoy this lucky draw. Right? Okay, so before I end the session, just back to our earlier discussion at the beginning where we talked about IQ and EQ, and I thank everyone who's staying back until now. So back to the discussion. We talked about IQ and EQ is important in trading. So how exactly does IQ and EQ work? Why do we need them? And what are the other factors or characteristics that a professional or a successful trader has? Okay, so we need IQ. Okay, definitely. Why? It's because we need to be able to learn fast, to be able to understand concepts, to be able to process information quickly, and this is required for us to create a trading strategy or to figure out how the market works. Okay, so having if we are smart, if we are have a good high IQ, probably we will be able to analyze information and come up with some trading style or trading strategy that can work. Okay, but as a trader, we know that IQ alone is not enough. Okay, because a lot of time the emotional part comes into play. So what does the emotional part affects? Most of the time it will affect our discipline. Okay, so how does EQ work? EQ means understanding of our feelings, understanding of our emotion. So one important part of EQ, right, in trading is to understand our threshold. What do you mean by that? I don't know if anyone here has trading experience like this. So for example, you put on the trade, but you didn't put any stop loss level. So most of the time you probably will be watching the market, and then if something goes wrong or it's not in your direction, not in your favor, you will cut. Maybe let's say you lose $50, you start to cut position. Okay, just an example. But one day maybe you put on a trade, and then suddenly you didn't have time to look at the market, and for the after a while, probably the next 1 hour or so, you lock in back, and the shocking thing is you see that, whoa, I'm losing $500 now. Okay, I'm in an unrealized loss of $500. Okay, so what is the usual reaction? So most of the time, right, I don't think anyone will straight away cut the position. Okay, the hope will come in. Everybody will try to hope, oh man, can this price go back? Maybe lose a little bit lesser, I will start to cut my position. Okay, so that is the natural reaction, okay, for most of us. So why is this so? Because there's this fear or there's this pain in us when we see the loss. Normally, most of the time, I'm just losing maybe $30-$50, but this time around, suddenly my trade went south and I'm losing 500. The pain is too much to handle. Okay, so it will become very irrational. Okay, maybe when we are losing $30-$50, we can still make very rational decision or very good decision. But when it comes to 500, somehow we throw all the rules out of the window. Okay, and understanding where we start to have irrational feeling or when we really start to feel scared is very important, because that means that is my threshold. Any losses after this, right, I'm going to go crazy. Okay, inverted commas, I'm going to lose my discipline. So for example, if a trader knows that if I were to lose more than $50, right, I probably will start to sweat and I may not be able to start cutting my position. I don't know where to cut already. Okay, so that $50 will probably be the threshold. Okay, so it's good to observe our feeling, to observe how we feel when we see our position in profit or in losses. Okay, especially in losses. Where do we start to feel very fearful? When do we start to really hope? Okay, hope is a very dangerous thing. Okay, so when we start to hope, that's probably over your threshold already. Okay, so understanding where we start to fear, when we start to fear, or where we start to feel pain, will help us set a realistic stop loss level. Okay, realistic stop loss level or position size to control our risk. Okay, so this is very important. So so having a good EQ, right, we can understand where we start to be fearful, and then we know where we can control, where we should really cut our position already before we can't make a good decision. Okay, so that's where the EQ parts comes in. But other than this, right, successful trader has another very strong personality. I'm not sure whether have you heard of this term AQ, adversity quotient. Okay, it's not something new. It's been in discussion for many years already. Okay, so AQ is adversity quotient. So it's the ability to handle failure, how we respond to failure. So a lot of studies has been done on this AQ, and they find that entrepreneurs, especially, they have very, very strong AQ. Okay, they are able to handle failures or handle adversity very well. Okay, that's why they can be successful doing their own business, starting their own business. Okay, because we know that it's not easy, and definitely you meet with a lot of failures, a lot of barriers and things like that that may make you want to give up. Okay, so having a strong AQ is also very important in trading. All right, so let me just give you an example. Trading is really very, very tough. Okay, you will realize that whether you make money or lose money, right, you will not be happy even when making money. Okay, lose money, of course, we know we're upset when we lose money, but sometimes make money, we are also upset. How? So for example, okay, I took a trade and I see that the trade is in my favor. I make $100, I took profit. The moment I take profit, the market goes in my favor for probably another $500. Okay, that's where you feel angry. See, even when you have a profit. Okay, that's where you say, hey, why am I like that? I should have held on. I should have hold on. The trend is still up and things like that. Okay, we start to blame ourselves. We start to say a lot of things and trying to reason why we didn't make the extra $500. Okay, you can make 600, but I only make 100. So you can see that in trading, right, there's a lot of emotion roller coaster. Making money, losing money, all seems to be a failure. Okay, so the ability to handle all this are very important. Okay, so just a little bit sharing, more sharing on AQ. What is it about? Okay, AQ stands for adversity quotient. It's the ability to handle failure, how fast we can recover from a setback and we get going again. Okay, this is the keyword, how fast we can recover. All right, so how fast we can recover depends on how fast we can accept the situation. Okay, this has happened. It's not the best, but it's not the worst as well, so I can move on. So probably, like for example, the example that I gave just now, if I make $100, but the trade went another $500 extra, it's not the best deal, but it's not the worst, right? At least it's not losing money. So if we accept, we won't be going in for revenge trade. Okay, so some of you who have been trading, maybe you will find that this happening to you, like wow, you took a profit $100, and then the market starts to go up again. You go in a revenge trade, but you're not buying, it becomes selling, because the reason you took the $100 is because you think that market's too high, it's already reached its peak, so you take profit. But then you continue to go higher. The very logical or natural action is to sell, to short, because you think it's high. All right. So and then of course we know that eventually all the profits is given back and maybe it turns to losses. Okay. But if let's say we are able to accept the fact that, oh, I made $100, but now market is in additional $200 in my favor. If you can accept the fact that, okay, I missed this $200, but is the market still trending up? If it is, maybe I can still buy, right? Yeah, maybe I can still buy. So you have a logical reasoning instead of just trying to go in for a revenge trade. So once we accept the situation, you'll find that your reasoning and your thinking, right, is probably better. Okay, so accepting is the first step. Adapting is probably is when, let's say, we're going into a losing streak. Sometimes the strategy just doesn't work. Okay, it happens. Traders go into losing streak. So we may want to think, is it because the market has changed, or is it because I didn't I'm not disciplined enough, I didn't follow my method closely. So we adapt. If the market has changed, okay, so I may need to review and maybe tweak my strategy, or probably even change the whole strategy. If some traders are so married to their own strategy or own method that they refuse to change even when the market condition has changed. So Adaptability is also a very strong characteristic for a successful trader. And then, of course, once we accept, we adapt, we have the energy and the what do you call that, the adrenaline to go again. Okay, this is very important because a lot of times after failure, right, you don't really want to do anything. Okay, it's okay. Maybe you want to take a break from trading a while and review, but it's not say depressed or really totally give up and forget about it. Okay, so the persistent, the grit in the trader is very important. Okay, so the go again attitude. So yeah, this is a simple sharing from me, okay, from the trading psychology part of things. So IQ is important, EQ is very important, but AQ will help us in the long run. Okay, the ability to handle failure or trades, right? Failed trade, and will help us in the long run as a trader. So if let's say you intend to really be in trading in the long run, or even turn professional, you may want to go more in depth into this AQ and probably learn more about it. All right. Okay. I think I'm a bit over time. Okay. Let me see what else I have. Okay, I think that's all I have for you today. So okay, let me just put this. Okay, so if let's say you want to join, want to have this a demo account, okay, you can feel free to scan this QR code, and you can open a live account with this QR code here with us. Okay. Oh, sorry, I think I didn't put in my contact number here. My apologies. Let me just quickly write down my email for you. Okay. Okay, I just realized I didn't have the page for that. Okay, so this is my email, and my number will be, okay, so this is my direct line. All right, so if you have any questions or anything that you'd like to discuss, want to ask, feel free to contact me or my team from the client relation desk. So my name is Simon. Okay, Simon Teo. Okay. Yeah. Okay. Hope you can see my screen. Okay, so that will be all for today in this session. Thank you so much for your time. I hope it has been useful, and do feel free to contact us. Okay, if you have any questions, if you are new to trading, you want to have some hand holding, feel free to contact us, because we always believe that you don't need to trade alone. We have a team of professionals to service you, to guide you along, so you don't have to be alone when you're trading. Okay, we have this human touch over here in Phillip. So yes, that will be all from me, and thank you very much, everyone. Have a good night.